All right, let's dive right into Workday's latest quarter. On November 25th, they reported what, on the surface, looked like a really solid set of numbers. But the market's reaction? Whoa, it was a completely different story. So what on earth happened here? Let's break it all down.
And when I say a different story, I mean it. The very next day, the stock got hammered. It plunged nearly 8%. And get this, the trading volume was roughly 4 times the daily average. That's not just a little dip, folks. That's a loud, clear, and pretty brutal verdict from investors.
So that's the big question we're tackling today, right? How can a company post what looks like a really solid beat, and then bam, the stock gets absolutely crushed? The answer, as it so often is, isn't in the numbers they just reported. It's in the story they told about the future.
But first things first, before we get into that forward-looking story, let's just level set on the actual results from the quarter. We need to see why everyone was so surprised by the stock drop.
And look at this. It's a pretty picture, right? A clean beat. Earnings per share came in at $2.32, comfortably ahead of what analysts were calling for. Total revenue also nudged past expectations, and that super important subscription revenue was right on the money. I mean, seriously, if you just looked at this slide, you'd think, okay, classic beat. This stock's gonna fly.
And it gets even better. The good news just keeps coming. Check out these other key metrics. The 12-month backlog, that's their future revenue pipeline, was up a really healthy 17.6%. Margins expanded in a big way, and free cash flow absolutely surged. They even bought back over $800 million of their own stock. The key takeaway here is simple. Looking in the rearview mirror, everything looked fantastic.
Okay, so here's where the plot thickens. Because Wall Street doesn't drive by looking in the rearview mirror, right? It is all about what's coming down the road. And when investors started digging into the guidance, well, that's when the cracks started to show.
Now, to be fair, management was putting on a brave face. You had the CEO, Carl Eschenbach, kicking off the earnings call by saying they delivered solid Q3 results, highlighting their strong execution. This was the company line, the official story they wanted to tell. But here is the disconnect, the real heart of the issue. You can see this huge gap between what management was saying and what the market was hearing. Management is talking up strong AI momentum, but investors are looking at the actual numbers and seeing, well, not much of an impact yet. Management points to a great backlog, and the market says, yeah, but some of that is from an acquisition. It's like they were speaking two completely different languages.
And this right here, this is the smoking gun. The outlook was, let's just call it lukewarm. Yes, okay, they nudged up the full-year guidance a little bit, but look at the trend. The growth rate is clearly slowing. And then they dropped this little bombshell, a preliminary look at next year, fiscal 27, showing growth of only around 13%. For a stock that trades at a premium price like Workday does, that kind of continued slowdown is a major, major red flag.
And remember that big, impressive 17.6% backlog growth number we just talked about? Well, turns out there was a little asterisk next to it. Once you peel back the layers, you see that a full percentage point of that came from an acquisition they just made, a company called Paradox. So the real organic growth from the core business, it was actually a bit softer than that headline number made it seem.
All right, let's shift gears to the topic everyone wants to talk about, AI. This is supposed to be the next big growth engine for Workday. And believe me, management spent a ton of time on the call hyping up their AI strategy, but investors were listening for one thing, and one thing only: show me the money. When does all this cool AI stuff actually start making a difference to the bottom line?
And you got to admit, the vision is pretty cool. They're talking about their platform becoming the central nervous system for a company, pulling together all the data on people and finances, and then plugging in this new workforce of AI agents. It sounds amazing. It's a really powerful story. And they're not just talking a big game. They are putting their money where their mouth is. They've been buying companies like Paradox and Sana, they're rolling out new AI products, and they're teaming up with the big dogs like Microsoft and Google. There is no doubt about it, they are all in on AI.
But, and this is a big but, here comes the reality check. After all that talk, all that investment, all that hype, AI products contributed just 1.5 percentage points to their recurring revenue growth this quarter. Just 1.5%.
Now, this is so interesting because if you look at adoption, it seems fantastic. I mean, 75% of new customers are signing up for an AI product. That's a great sales metric. But it's kind of like selling a ton of movie tickets for a theater that isn't open yet. The revenue impact today is just lagging way behind. And the market sees this gap and thinks, okay, This AI story is real, but it's a story for 2027 or 2028, not right now.
Okay, so let's put all the pieces together. What does this all mean for the stock going forward, and what are the key things you absolutely need to watch for in their next report?
It really boils down to this, a valuation dilemma. Workday has always been an expensive stock, and you can get away with that when you're growing super fast, in the high teens or 20s. But now, with organic growth settling into the mid-teens and guided even lower, that fancy price tag starts to look really, really hard to defend.
So for us, that lands us at a market perform rating with a price target somewhere in the $210 to $225 range. Our thinking is pretty straightforward. The narrative has completely shifted. For the last year, it was all about, look how much more profitable we're getting, and they delivered. But now, that story's over. The focus is squarely on growth, and right now, that deceleration trend is the only thing that matters.
So when they report again in February, here's your checklist. Thing number 1, and it's the most important by far, the formal guidance for fiscal 27. Is it really going to be that 13%? Thing 2, that 1.5% AI contribution number. Does it start moving up? It has to. Thing 3, are the acquisitions they made like Paradox and Sana starting to pay off in sales? And finally, listen very closely to what they say about the broader economy and customer spending.
And that leads us to a pretty interesting, let's call it a wild but plausible trade idea. Think of the stock right now as a coiled spring, wound tightly around one single data point, next year's growth rate. When that formal guidance drops in February, this stock is going to move, and it's probably going to move big. The tricky part is, which way? So instead of betting on a direction, you could play the volatility itself. One way to do that is with an options trade called a straddle, where you buy both a call and a put. You're basically just betting on a huge swing, either up or down.
So there you have it. That's our breakdown of Workday's wild quarter. The big takeaway is that the game has changed. The market's focus has shifted from margins to growth, and that's a story we'll be watching very closely in February. This is not financial advice.